Okay, so today we're going to be going over cash flow available for debt service coverage, cash flow available for debt service, cash flow after investing, and then the income statement as well, the income statement analysis. So it shouldn't be too hard. None of this stuff should be too hard. We went over it all in class. All right, so let's go ahead and get started. So for me, I'm opening up the same stuff that I open every time. I'm doing the example project. You guys are going to be working out of Neptune, Titan Hall, Brian's Beans. Also, some of you guys were having issues with Adobe Acrobat. Remember, when you open this app, let's say for some reason you can't get it on your computer, you can download Adobe Acrobat onto your iPhone. And then you can access it through your email onto your cell phone. So remember, you can download Adobe Acrobat and then access the information and edits that I send on your cell phone. So anyways, let's go ahead and get started. What you're going to need today is the Excel, policy guidelines. You're going to need the Excel. You're going to need the policy guidelines. And then let's go into project. You're going to need the conversation. You're going to need the debt schedule. And you're going to need the financial statements. Okay. So just to start, we're going to start off with the debt schedule. Oh, hold on. We need one more thing. We're also going to need the one project template. The project. Okay. So we're going to start off with the Excel. Now, what I'll do is minimize this, bring this up. Right, so the debt schedule. You might be wondering, well, Makai, what does the debt schedule tell us? Well, for me, I'm not going to keep these documents open as two separate documents. I'm going to put it all in one page. So I'm going to copy that, and then I'm going to paste that here, right? So that way I don't have to go back and forth. I don't want to go back and forth. I shouldn't have to. Copied and pasted it here. So in that document, we have the debt schedule. What the debt schedule tells us is how many loans they have outstanding. And then it tells us their repayment policies for those loans. So for my company, they have the interest only subordinated debt because remember, in the last conversation, we discussed with them to ensure that they're willing to subordinate that loan that they got from related companies, right? Then they have the interest only proposed debt, which is going to be highlighted in the light blue. Is going to be highlighted in light blue, right? In light blue. In our debt schedule, we have 3 loans here, light blue, subordinated debt, principal, interest only, right? So now we're going to take that, we're going to put 1,000, 1, 2, 3. And remember, we're going to assume that the proposed loan that we're giving them, you can assume that it's fully funded or you cannot. Me personally, I'm going to assume that it's fully funded. So right here, it says the current amount is $200,000. But because we're renewing it, we're going to assume that it's fully funded. Remember, check your term, check your amortization. Right? My term, my amort are 12 and 12. We're going to do Wall Street Journal Prime plus 1.75 plus 1.75. Let's make sure that's right. I'm not sure that's right. What's our spread? Our spread is 225 bips. So we're not going to do 1.75. Right here it says plus 1.75. disregard that. Don't use that number. Use the number that it says from the um, loan structure. So if the loan structure says risk rating 5, we're going to do a risk rating 5, come to loan structure, risk rating 5, which is 225 bips over Wall Street Journal Prime. Now, if we want to find Wall Street Journal Prime, we're going to click on,
trying to get people to sign a petition.
We're going to click right here. It's going to open it up. It's going to lead us to this. So Wall Street Journal Prime today is 7.25. The Federal Reserve just reduced rates. So remember, the Federal Reserve just reduced rates. So you guys are going to have to re-pull rates one more time. So anyways, it's 7.25. So right here, I'm going to change that to 7.25. Right? We're going to take this, copy it, copy as picture. Okay. Then we're going to come to our loan structure. We're going to delete that one, paste this here. Now we have 725, right? So instead of this being 975, it's going to be 9750 or 950. And then we're going to say as of 9/21/2025. So we updated it. And if you're watching this in the future, if you're not watching this in 2025 and the Federal Reserve didn't change rates during the duration of your project, then you're good. You don't have to make this update. But if you're watching this in 2025 and you're my 2025 fall class, I know that rates were changed, and that means you guys are going to have to come in here and update this chart as well. So anyways, we're going to do Wall Street Journal Prime plus 225 basis points, which is 950 basis points. So if we come back to debt service coverage ratio, we're going to do 9.5%, right? Now, this is interest only. This is interest only loans. So here we have interest only. And then here, down here, we have principal plus interest. Up here, we have principal and interest, okay? I want y'all to make sure you can tell the difference. Principal and interest. Interest only. This is the interest only section. This is the principal and interest section. This is the principal plus interest section. Do not make the mistake of putting an interest only loan into the principal and interest section, and don't put a principal plus interest loan in the interest only section. You need to make sure that you're putting these things in the right sections. So anyways, we have our loans, we're putting them in, blah, blah, blah. Now I'm going to do the principal and interest loan, which was 250, original amount, 200 outstanding, 60-month term, 60-month fully amortizing, 60-month amortization, 8.25%. They're charging 8.25% as the interest rate. Remember, you guys are going to have to pull, like this says Wall Street Journal Prime plus 1.75, but we know from the loan structure that this is a risk rating 5. It's a risk rating 5. So we're not going to do 1.75. 1.75 is a risk rating 4. We're going to do a risk rating 5, 2.25. So don't go, when it comes to the proposed loan, don't take the interest rate that's in this right here, because remember, this is the loan that we're currently giving them. We're underwriting this loan. That's what that's called. We're underwriting, which means that the terms that they have currently are going to change upon the funding of this request. And if you don't understand that terminology, please look it up. So anyways, I've gotten all 3 loans put into my charts here. And also, I want y'all to know, if you need help, you get lost, come over here. There's instructions on the cash flow available for debt service. And then there's instructions for the proposed debt section. And then there's explanations over here. So I know some of you guys are going to be confused when it comes to, hey, Makai, what do we do with taxes? Well, there's something over here that explains how taxes work for C Corps. That's something that explains EBITDA less taxes, so EBITDA minus taxes. That's something that explains non-recurring events. There's something that explains cash flow available for debt service. And then there's something that explains excessive distributions. Okay? All of that, it can be explained. I want y'all to don't be afraid to come to the right and look at the explanations. Okay? Okay. Okay. So some of you guys are gonna have taxes. If you have a C corp, you're gonna say yes, right? If you have a LLC, a S corp, LLP, you know, GP, LPs, you're gonna come over here, right? Sole proprietorship. You're gonna come over here and you're gonna say no, right? And the reason you're gonna say no is explained over here when it says C Corp and taxes, right? C Corps are taxed differently than all other organizations, while other organizations must distribute some earnings to shareholders to pay taxes on behalf of the company. C Corps report their taxes on their income statement. So in order not to report taxes twice in our model, we remove the tax calculation. As for the corporations, we must estimate taxes unless we have tax statements from all shareholders. To do this, we take 37% of net income and subtract it out. Anything distributed that exceeds 37% is a discretionary distribution, meaning that shareholders took the money out of the company for something other than taxes. Now, remember, we're making the assumption that everything above 37% is discretionary. How did we come up with the number 37%, Makai? I don't know. Well, it's right here. If you go and there's a little comment, and the comment states taxes are estimated to be 37% to be conservative. The maximum amount a company can be charged for taxes is 37% of net income, and that only applies to Texas. It's different in every single state. Texas happens to be a state that does not charge income tax on the state level. So some states, this would be 54%, right? Some states it's 62%, right? But in Texas, it's only 37% because you only have to pay federal income taxes, okay? Federal income taxes, okay? Okay, I know I just threw a lot at you. I just threw a ton at you. I know, it's hard. So, anyways, back to what we're doing. This section over here is titled Proposed Debt. We calculate interest only payments, and then it spits out the total interest only payments that will be paid within a year. Then we have total P&I payments that will be paid within a year. We have total P plus I payments that will be paid in a year. And then we combine all three. Right here. Then we combine all three right here. And the total payments. Now what this chart over here does is it takes that total payment and it puts it in the proposed debt section. So our proposed debt consists of our total payments in a year. Now what we're doing in the above part is we're taking the cash flow available for debt service. So we're going to take the most recent 3 periods of financial statements. We're going to take earnings. We're going to add back interest because interest is calculated in the total payments, right? Interest is calculated in the total payments, and the total payments is in the denominator. So we don't want to charge them twice for interest because we calculated interest here, this is total principal and interest payments, and it's in the denominator, we're going to add it back in the numerator so that we don't understate their income. We're going to take out taxes because we're going to assume that a company will pay the government before that company pays us. Plus depreciation. Depreciation has no cash effect. Depreciation does not affect cash. So remember, cash is not impacted by depreciation. Depreciation is the recognition of a loss in value on an asset. It is not it is not an actual cash expense. It's the recognition that an asset has lost value. Okay? And because of that, it does not have an effect on cash. It's a non-cash expense. So we're going to add that back in. That gets us EBITDA, earnings before interest, depreciation, and amortization, minus taxes. That number right there is going to appear right here. The next thing we're going to do is we're going to add back one-time expenses. So imagine they lost a lawsuit to somebody. We're going to add that money that they spent on the lawsuit back to their income, because remember, we want to stabilize the cash available for debt service. We want to stabilize that. We want a clear picture. Remember, companies aren't usually being sued, and they definitely don't usually lose lawsuits. So we're not going to assume that that is a normal happening. We're going to assume it's abnormal. Thus, we're going to add it back. Okay? I don't know why my mouse keeps flickering. Anyways, we're going to add it back. Now, less one-time income. It's the same concept. We're going to assume that the company does not always win lawsuits. So we're going to take that money out because it's not normal income. Now, the same with the sale on asset. The company isn't in the business of selling big giant things of machinery. They don't usually sell tractors. But in this year, they did sell a tractor, which made them abnormal revenue. So we're going to take that abnormal income out of their normal cash flow available for debt service. Whereas if they had a loss on a sale of an asset, we're going to add that back in because that's not normal. And remember, if you get confused, there's all this information over here that can explain it for you. Okay? Now, loans to shareholders. Remember, a loan to a shareholder means that you gave away money. You gave away cash. In 2023, they gave away $101,000 worth of cash. In 2024, that same shareholder or that same related company repaid $196,000. Whereas in 2021, they loaned out another $1,000. Loans from shareholders, if it's going down, that means that we're repaying our shareholders. Because remember, loans from shareholders, when it goes up, that means that we have received cash. If it's going down like it is in 2023 and 2024, that means that we are losing cash.
You're trying.
Okay? So, I want y'all to take note of something. CFADS. What is CFADS doing? What is cash flow available for debt service doing? It adds up all of these rows. So it takes EBITDA less taxes and then it adds back and subtracts out one-time occurrences. And what that does is it gives us a clear picture of what normally happens with the company's cash flow. Now, because this customer had such an abnormal loan from related companies, we are going to subtract that from their income. We're going to take it out. And the reason we're going to take it out is because this number is so abnormal, and we had comments from the customer on that loan. We had comments from the customer, right, saying that they'll subordinate that loan. We can assume that this is not normal income for them. So I'm going to subtract it out in the blue tab. Remember, this is the only row that you guys can edit. This is the only row that you guys can edit. The only reason why you should have something here is if the borrower says something like, this loss was not normal. If they give you an exact amount of expenses that they will not have again, I want you to come here and I want you to add it back. If you have Brian's Beans, I know for a fact that you have one-time expenses that the borrower tells you about. If you have Neptune, I'm not sure, but I would still check. And if you have Titanhall, I'm not sure if you have one-time expenses, but I will still check. But Brian's Beans, I'm certain that you have one-time expenses. And I also am certain that some of you may have one-time income that isn't broken out in the income statement, which this is pulling from. And you might have to go in manually and type in $275,000, right? You might have to manually type in minus $240,000 so that you can stabilize that cash flow available for debt service. And we can tell how much cash they're actually able to generate. So remember, in my case, I'm going to subtract out the exact amount of this loan. That way I can get a clear picture of what's going on. Okay? So now, time for the actual analysis. All right. To do. We'll print the most. Where is it? Here we go. Okay? Remember, I updated this already. We're going to come down. We're going to come down to the capacity section, free cash flow. So, highlight everything. That's the first order of business. We're going to delete this chart. And we're going to come here. We're going to grab this chart. Copy picture. And we're going to move it over. Enter here. Okay. So, debt schedule. Remember, we have our, oh wait, that's actually pretty similar to what we have. We have our $1 million revolving line of credit. But remember, they're not going to be with Bank of America. You guys work for Texas Southern Capital Bank, right? That's who you guys work for. Principal due at maturity, interest only, not SOFR, Wall Street Journal Prime, plus 225 bips. Now remember, this is the loan that we're working on. That's why I changed everything to match my terms. Now, let's say $1 million, subordinated debt, held with related company, comma, principal and interest, nope, interest only. Now you can type what I did, where I typed I/O, which means interest only, or you can type interest only and spell it out. So we're going to say fixed at 9%. 9%. There is no term or amortization on it, so we can do that. That, remember, when they subordinated the loan, they agreed that they will not amortize this debt, which means they won't be repaid. Okay? And then they have a $250,000 term note. I'm not sure who that's held with, so we'll leave it alone. What in the world? What was that about? Well, that was weird. My screen is super bright. Okay, term note. Right, let's open that up. Term note for equipment. Right. Fixed at 8.25%, comma, $60 months, fully amortizing. So for you guys, what I want you to write here basically is loan amount, purpose, held with who. If you know, if you don't know, don't write that out. Held with who, rate, and by that I mean floating. And then I want to know, floating, or is it fixed? Then I want to know index. This is if it's floating. If it's floating, I want to know index plus the spread. Okay. And then I want to know term in months. So you see how I have it in months at 12 months? I want you to put term in months and amort in months. Now, if your amortization and your term line up, I don't want it in months anymore. I want it to say term in months, fully amortizing. I want you to say that, fully amortizing. Okay, period. This is what I want you guys to write out. Okay? So anyways, I got my debt schedule. Okay, and now onto the cash flow model. Explain significant amounts of depreciation. So my customer does not have significant amounts of depreciation, but let's say they did have a significant amount of depreciation in 2024. What we'll say is the customer depreciated, let's say they depreciated $1 million in 2024. Fiscal year in 2024. They did this because, let's say inside the conversation, it says that they did this for tax purposes. Let's say in the conversation they said they did this for tax purposes, right? But let's say there's another time, right? Let's say something else. Let's say in fiscal year 2024, they did this not for tax purposes. They did this because they had not previously recognized this expense, causing a delayed write-down, right? Not a delayed write-down, an accelerated write-down, accelerated write-down, right? Causing an accelerated write-down. Or let's say they didn't do it because it was an accelerated write-down. They didn't do it because of that. Let's say inside the conversation, they say that they did it because they, had a had to offset new purchases. I don't know. They come up with all kinds of things. So inside the conversation, whatever it says, that's what you're going to need to write. You need to read the conversation. In my situation, there is no significant depreciation. It's 10 and 6. Explain loans from their shareholders. Do we have terms? Right. So remember, I already explained the loan from the shareholder up here, but I'll explain it again because down here it's asking for something different. In 2024, in 2025, in year to date, in year to date 2025, the borrower took on a $989,000 note from related companies to purchase machinery. Terms are documented above, period. This note is subordinated to Texas Southern Capital Bank. Remember, you guys work for Texas Southern Capital Bank. I'm sad this video is getting so long. I'm going to try and speed it up. Okay. Explain sales of assets. Remember, my customer does not have sales of assets. And the only reason you should have to explain sales of assets is if it's very significant. Very significant means they're having a sale of asset that's close to or more than EBITDA less taxes. All right. Okay. Explain non-recurring income. My customer does not have non-recurring income. They don't have non-recurring expenses. But let's say they did have non-recurring expenses. They should explain it in the conversation, and you would do the same thing you did for depreciation. But let's say they don't explain it in the conversation. What you're going to need to do is see if you can't figure it out from the financial statements. If you can, good, write it down. Where is it coming from? They sell bed sheets on the side and report it as other income, right? And then you can write that there. But in my case, they don't sell bed sheets on the side. Can they cover the debt? Right. So you're not going to write down, yes, they can cover the debt. What you're going to write right here is in fiscal year in 2023. Oh, no. DSCR is 0.84x, 0.003x, 0.30x, and 0.30x in the period fiscal year in 2023 through year to date 2024. They they covered the debt in less than 1. So for you guys, let's say they cover the debt. You can say they cover the debt in all periods. You can say they cover the debt in 1 period. They cover the debt in 2 periods. And then type out what periods. So you're in 2024 and 2025. Now in mine, they cover the debt in no periods. In no periods. So we're going to write down in no periods, right? Okay. They cover the debt in no periods. So now we have a more realistic version. This is the ISCF model. And you guys, I may have referenced this as CFAI model, the CFAI model, which is the impact on statements of cash flow. So we're going to come over here, right? And we're going to grab this from right here. Impact on statement of cash flows. Copy as a picture. Someone puts it. Okay. Here we go. Okay. CFAI model. Right? So we have this model. Can they cover the debt? Can they cover the debt? Right. We're going to do the same thing. CFAI. No. Cash flow after mandatory payment. Cash after mandatory payment. CAMP. Camp is greater than 0, greater than $0 in fiscal year end 2023 and fiscal year end 2024. They can cover the debt in 2 periods. Period. Now let's add one more bullet point. In this one, I want you guys to understand what's going on here and what makes this one different than this one. What makes the CFAI model different than the CFADS model? CFADS is a multiple. CFADS is a multiple, which means it's division. CFAI is not a multiple. It's cash after mandatory payment. And basically what we're doing is we have cash flow from investing. Cash flow from investing, that's cash that you gain after investing activities. And then you have cash flow from operations. This is cash you gain after operations. So if we go to their statement of cash flows, their cash flow after operating activities and their cash flow after investing activities, we combine those two so that we can get cash available for debt repayment, CFAI, cash available for debt repayment, which is cash flow after investing activities, right? We add back interest for the same reason that we add back interest here. We calculate the proposed debt, right? And then we subtract this with this, and then we get this. I hope that makes sense. I know I went fast. If you are lost, please come over here and read this chart that says proposed. Read this one that says, come over here to the right, and where it says impact on statement of cash flows, chart number 2. It explains what's going on. It'll tell you in greater detail than what I just explained. Remember, this is putting your proposed debt directly onto your statement of cash flows, and it determines how much cash they'd have after they invest. And remember, in this year, they purchased $1 million worth of equipment, but also in that year, they took out a loan of $1 million. So they really only lost $600K that year, but that doesn't matter. The point is that in 2 years, they were very capable of paying our debt back. In 2 years, they could pay our debt back and they'd have some cash left over. And that's what we like to see. That's the whole reason why we analyze this. So please keep in mind significant Okay, now I want y'all to keep in mind, like, this, I mean, we're not done. We have one more thing to do, which is the distributions. But I want y'all to understand this model just as well as you understand this model. If you don't understand it, please go and read the chapters that explain it. The chapters will explain it. I want you to go and read the chapters that explain what's going on with this model and what's going on with this model. This model is a little bit more important than this model to me personally. Now, this model in the banking industry is more important to most bankers, but this model to me is more important. So remember, this is a personal preference. But if you guys can wrap your head around this model right here, you can save yourself a lot of trouble later down the line when you get into the banking industry. This model is how you model a company's ability to repay cash based on their statement of cash flows, which is the third financial statement. This is the third financial statement. There's the big three financial statements. There's a balance sheet, income statement, and a statement of cash flows. Remember, the statement of cash flows reconciles all the transactions that occur on the income statement, the balance sheet, through the cash. Remember, your cash is reconciled via all the activities that happen on the balance sheet and all the activities that happen on the income statement. That's how you reconcile cash. And this statement of cash flows is the reconciliation of cash. This was done on an indirect basis. And remember, we're taking that and we're putting it here. So one more thing to do and then we're done. Distributions.